and welcome to the second installment of the How to Sell Your Business series from the New York Mergers, Acquisitions, and Transactions Roundtable, part of USA 500. This seminar is called Finding the Right Buyer. My name is Andy Abramowitz. The scheduled moderator for today was Gary Rosen of Markham, who was pulled away by an urgent work matter. I know Gary has a lot of fans expecting him here. I believe they call themselves the Rosen Heads, but as backup moderator, I will fill in as best as I can. As you can see, this seminar is the second of a series of 7 seminars continuing through mid-December. We are now in the section dealing with preparing for a sale, followed later by engaging buyers and doing the deal. You can register for future seminars at the link on the USA 500 site noted at the bottom of the screen, or in the same way that you registered for this one. Thank you to USA 500 for hosting this for us, as well as Markham LLP for supplying the WebEx platform. You can see the disclaimers on your screen. Just to summarize, the statements made in this seminar are general in nature and aren't intended to be legal, accounting, tax, financial, or business advice. Now I'd like to briefly introduce our expert panel. Andrea Cantor is an accomplished corporate transactional lawyer and business advisor with over 25 years of combined legal experience in large New York City law firms and in executive positions at public companies. Andrea is currently the owner of the law office of Andrea Cantor PC, where she advises startups, public and private companies, and business owners on a broad range of corporate transactions, including mergers and acquisitions, SEC reporting and disclosure, and general corporate matters. She represents companies throughout the corporate life cycle, from formation to mergers and acquisitions to capital raising to exit strategies. Andrea often serves as outside general counsel to startup and established companies. Jackie Copcho is the founder and managing partner of Big Branch Capital, an investment firm that acquires privately held companies. Jackie has an extensive background working in the consumer products, financial services, healthcare, and technology industries. Larry Thal is a partner at Acela Partners, a specialty employee benefits brokerage, which he joined after years of advisor on health insurance and other benefits matters. To many businesses, he is involved in their decision-making regarding a possible sale of the company. And I am Andy Abramowitz, the founder, over 10 years ago, of Andrew Abramowitz PLLC, a boutique corporate and securities transactional law firm comprised of attorneys like myself with previous senior-level experience at large New York firms. We represent companies in their life cycle transactions, including formation, capital raising, and mergers and acquisitions, as well as SEC public company compliance and day-to-day general corporate matters. The structure of today's seminar is that each of our 3 panelists will give a presentation, and then we will leave time for questions from all of you. If you would like one of us to address a question, you can type it in the Q&A area in the lower right of your screen. Okay, without further ado, I'm going to first hand things off to Andrea Cantor. Andrea, I think you're on mute.
So you've made a decision to sell your company. Now the question is, how do you find the right buyer? This could have an impact on the sales process and how the deal navigates its way throughout the sales process. In general, there's 2 types of buyers. There's a strategic buyer and a financial buyer, and they could have an impact on how your deal goes depending on which buyer you select. The strategic buyer tends to be an operating company that provides products or services. They're looking to purchase and take over your operations. They could be competitors of yours, suppliers, or customers. They may be unrelated, but looking to grow in your market to diversify their revenues. They tend to take a buy and hold strategy and are in there for the long term. Whereas the financial buyers, which could include private equity firms, venture capital firms, hedge funds, family offices, and ultra-high net worth individuals. They're seeking to realize the highest internal rate of return to investors and plan to sell in 5 to 7 years by exiting through either a sale or an IPO. They're comfortable with the part ownership stake, so might attract sellers who are looking to just do a partial exit. Next slide. Different buyers have different goals. A strategic buyer is looking to identify companies whose products or services can synergistically integrate with their existing P&L. They're looking to create long-term shareholder value and eliminate redundancies. So there was a company in the paint business, and they had a territory that was in the tri-state metropolitan area, and they were looking to expand their geographic reach. So they were interested in buying a company that had the southern territories and served different customers, so they could eliminate some of the duplication in HR or IT or finance functions and basically have all the revenues drop to the bottom line. Whereas a financial buyer is looking to identify and invest in a private company with attractive growth opportunities. They tend to buy low and sell high, and they really, because of the fact that they have to return money to their investors, they really don't want to overpay for a company. Next slide. How do buyers evaluate your business? Strategic buyers could ask the following questions. How will your business tie in with their existing company? Are your products sold to their customers? Or does your company serve a new customer segment for them? Are there manufacturing economies of scale? Is there some intellectual property that will be a valuable asset for your company? Or are there trade secrets? Whereas a financial buyer, generally, unless it's going to be an add-on acquisition to a portfolio company, there's not an integration of your business into a larger company. They generally evaluate transactions as a standalone-based entity. They often buy businesses, at least partially with debt. Sometimes the debt leverage could be as high as 80%. So they're looking to analyze, can your business generate enough cash flow so that they would be able to service the debt? Next slide. Sometimes buyers share similar characteristics. Strategic buyers act like financial buyers, and financial buyers act like strategic buyers. Sometimes a strategic buyer is just trying to boost their earnings and act like a financial buyer. They're going to focus less on the back office infrastructure, since these functions can often be eliminated during the post-closing phase. If a financial buyer could be like a strategic buyer because they already own a company in your space and are looking for strategic add-ons. For example, my daughter went to a sleepaway camp in New Hampshire, and her camp was bought by the camp group, which basically did roll-ups of all sleepaway camps, because the current owners, who was a family that owned sleepaway camps for many years, they either wanted to cash out or it became very expensive to run a camp. So a professional organization came in and they basically bought the camps from the current owners. And for the most part, the owners exited the camp, and then they put in professional management as camp directors instead of the directors that had been there through multi-generations. Okay, next slide. What type of buyer is right for your company? You have to ask yourself the following questions. If your main concern is getting the highest price possible, a strategic buyer is probably the best fit. Because of the synergies that they could realize and the elimination of duplicate functions, they're more willing to pay a premium for your company. If the seller wants a high price but also wants to protect non-management employees, a financial buyer will be a better fit because they're likely to retain personnel because they lack the expertise to run the business. If the seller wants to cash out but remain for a few years, a financial buyer is probably a better fit because the strategic buyer has the expertise to operate the business. If the seller's looking to make a partial exit or have some upside with stock, it's better off going with a financial buyer because they'll buy partial ownership. Although in some instances, a strategic buyer could utilize stock to buy a company, and then you could realize as current management some upside potential. Next slide. Strategic buyers may be willing to pay a premium to grow your business, as I just said, because of the possibility of eliminating duplication and having the profits drop to the bottom line. There could be a risk of customer concentration with a strategic buyer. So say a supplier purchases 60% of their supplies of their goods from your company and then purchases 30% of the goods from a buyer's company. They might not want to continue doing business because they don't want to have 90% of their goods purchased from one vendor. So that's something that would exist, that wouldn't exist if you went with a financial buyer. A financial buyer is focusing on a high growth model in order to realize the highest internal rate of return to investors, and they're likely to retain current personnel in place. Financial buyers might be more aggressive in reducing overhead because of financial leverage. For example, I was with a company and someone made a significant investment in the company and they did it in a highly leveraged basis. My client had very expensive office space in Midtown Manhattan, and it was a corporate holding company. So the investor insisted that we move to the suburbs and get rid of the costly office space because they needed to make sure that we generated sufficient cash flow to service their debt. Next slide. Basically, whether you go with a strategic or financial buyer can mean big differences when it comes time to get a deal done. There's no right or wrong answers. It's a personal as well as a professional decision. And in any way, throughout this process, you want to get to know your buyer. There's differences in capital structure, management methodology, and market expertise that all play a role in the sales process. You should ask yourself some of the questions that I had stated before, and analyze your goals, and then consult experts who could help you navigate the sale process and select the buyer that's appropriate for your business. Thank you.
Thanks, the next panelist. Just a reminder for anyone maybe who joined late, if you have any questions for the panel, we'll address at the end. Please type it in the Q&A box on the lower right. Now we're going to turn it over to Jackie Cox.
Yeah, thank you so much, guys, for joining. And Andrea, I mean, it is so important for buyers to understand, for sellers to understand who their buyer is. As a buyer, what you want to do is, you're looking at businesses, you're understanding kind of how the landscape is. But as a seller, for somebody that's looking to sell their company to somebody, you need to really check and make sure what you want, and what you want, that aligns with who you're selling to. You never want to see, fit your goals to what they want, right? Always kind of set your bottom line. And, from what I'll explain in this landscape right now, there's a lot of capital out there, and there's a lot of opportunity to find a buyer that fits perfectly with what you're looking for. So, looking at the M&A landscape in general, it's a very interesting time. I think, starting off in January and February, it was just, things were getting busy. March had a lot of uncertainty. COVID, there were businesses that were affected, virtually every walk of, the life cycle, the business cycle. And I think this is for a few reasons. One, nobody knew where to touch with COVID. There was, this global pandemic. We were kind of waiting to hear what was happening, from political perspective, businesses were closing down. We didn't know when they were going to open. So you could imagine that, nobody was necessarily selling their business during that time. Nobody was really looking to buy many businesses that time unless they were very opportunistic buyers. But what we're seeing now are the numbers increasing significantly. And, for Q4 of 2020, that's going to continue. And I look at this as 3 reasons. Number one, business owners, this has been a roller coaster of the last few months. It's a tiring process dealing with CBP, dealing with the pandemic, your employees, also, personally. Now that people kind of have an idea of what things will look like going forward, it's not just going to be coming back and do business as usual. Things are going to have to change. People are going to have to innovate. And there are going to be a lot of business owners, and you may be one of them, that, you just don't have it in you anymore. And that is, that's an opportunity, right now is an opportunity, and that's a fine time. For some business owners, their businesses are doing so well that they want to kind of get out at the peak of where their business stands. And then the third reason why we're going to see a lot of businesses come onto the market is there is uncertainty with the election. If one way or another, especially going into 2021, if taxes do go up, a lot of people are trying to sell their businesses in advance. So that's why, we're seeing all of these new deals on the rise. In terms of LOI, that's an indication of how many interested buyers there are out there, right? So the number of, the appetite of buyers, whether it's strategic, whether it's financial, whether they're independent sponsors, which is the model that I am, people are looking for businesses where, the owners are ready for that transition. And, there's a lot of capital in the space, a lot of dry powder that people are ready to, to start backing people or, acquiring businesses on their own. So between the rise in the deals, buyers out there looking for great, for great businesses to take over, and the increased capital that looking to acquire businesses, we're in a very, very interesting time in the M&A landscape. And like I said, I think that's going to continue going through at least the end of Q4 2020. So as a seller, it's extremely important for you to know who you're selling to, right? This is not just a professional decision. This is a personal decision. You have created this business. You have built it from, whether you acquired it yourself or you started from scratch, right? You have a lot of time. You have a lot of money. You have a lot of pride invested in this company. That goes for you, that goes for your family, that goes for your community and for your employees. So what I always suggest, and as a buyer, my number one thing is, who is the seller? Why are they selling the business? What do they want to do after they sell? And for sellers, you should be so comfortable with your buyer that you think, I could sit down. I always say it's like whiskey test. If I could sit down and have a whiskey with the seller after, then I know we're in a good spot. So don't overlook the importance of the personal relationship with whoever you're selling to. And that goes for have a conversation, but you also need to do your due diligence. For companies that have done this in the past, who have they acquired? When did they acquire them? What did they do, when they were acquired? And I know that Larry's going to touch on kind of the employee side. You can look at past trends and, compare that to what you're learning from the buyer. And if they're, they could tell you one thing and potentially do it better. So, it's not about trust, it's about verifying, right? I mean, you always want to have that good gut feeling with your worker, but you also want to make sure you look at their history and look at what they're doing. And another part, if they're going to be stepping into this business, what is their operational experience? Do they understand your industry? Do they understand your market? What, culturally and managerial-wise, how do they operate? And will that fit in with with your overall idea of how you run the business, or, you know, how your staff would, you know, would communicate with them. And that's a big part of it. We want to make sure that if somebody's going to be stepping into that role, they, you know, have an understanding of everything that's going on. You know, to kind of just recap this, there's a lot of opportunity to buy, and there's a lot of opportunity to sell. Make sure you know who you're selling to, and you know who they are personally. And it's you see a lot of good people right now on this panel that you can talk to if you are a seller. But it's, you know, there's no time like the present. But I think we'll get into that in the next slide.
Okay, Jackie, we're finished for now. I just want to make sure I got through your slide. Okay, thank you. And I'm definitely going to incorporate the whiskey test into how I advise my clients from now on.
Good way to go.
Thanks for that. Okay, now I will turn it over to Larry.
Hello, everyone. Thanks for joining today. And Jackie and Andrea, I'm still able to learn, and thank you for your wisdom. A lot of these questions that are put here, Jackie has, you know, touched upon, and I would like to turn it into the following slide. So there's a cue. All right, thank you. We are not to presume that once you get an NDA, you're on a glide path to closing, because you're going to say, am I on the runway? But you have to ask, and ask continuously, looking out for your interests. Are we at the same airport, I say? Because there may be a perfectly legitimate business looking to purchase yours, and yet you don't align. You have to constantly ask questions during the interview process. And you have to ask open-ended questions so you get a feel for the buyer. What are their intentions? Are you, do they have a style of hyperbole or understatement when stories are told? Do they get back with information promptly? You know, what is the course of dealing you're going to establish with them? It's essential, because that's, as it begins, so it goes from that day forward. I think an important question is, you know, you have to find out their plan. Andrea was talking about the 5 to 7 year plan with a financial buyer, but also, do they plan to operate? And what adjustments would be made? For instance, these people who help, my employees, my key people who help me build my entity that I put blood, sweat, and tears into, what is their intention at that point upon purchase? Do they have a compatible program for human resource information systems, human capital management? Is this a West Coast company coming to my area here on the East Coast, and they have a network of doctors in their medical program, which just doesn't fit, a tiny little network when we have huge networks here on the East Coast? You just have to take that second look, because when you sell your business as an ongoing entity, whether you remain or not, we'll visit that in a minute, you have to look at the morale of the employees. Will they remain? How many will be substituted? Is there still a future for them at the new combined entity? And that would go for key people. Do they have their key people insured to provide for continuity? These all give indications of, will help you formulate your impression, and whether you'll proceed to the next step. So one of the key questions is, do you intend to continue as an employee of the new company, the buying company? Well, ask yourself, would I want to work for the buyer? Not simply looking at, is this a good place to work and the number of stars on social media, but what is the morale? What is the culture, the ethos at the company? Do they work on tiny margins, and employees in certain roles are fungible and they have high turnover? Okay, so that's one of the things. Another thing to think about is the reliability of the information. So your employees, at some point, well past an NDA, into the process, someone's going to get wind that the company may be up for sale. And it's up to you to be right on time when you communicate with your employees. If something is in the offing and the word is out, there are people that can handle those kind of scenarios with employees when the word gets out too soon. But in a better circumstance, if you have the opportunity to control the dissemination of that conversation and that communication, that is very important. Each communication, not just between seller and buyer, but between seller and employees, is very important once the deal is in progress. I'm going to ask you to switch to the next slide. Okay, thank you. Well, I think Jackie has touched on this to some great extent. But on the due diligence side, the trust factor is so important. And Jackie a little bit stole the thunder, but I wasn't going to go the whiskey route, but an in-person conversation where hands can be shaken and character indicators communicated and transferred. Because remember, I think in the law they say reasonable minds may differ, and same with a business transaction. You can walk away at any time. But this really emphasizes the fact that if you're going to go down this runway, it's going to be a process, and don't expect a quick close. We have, obviously, certain instances might dictate that, but generally, I'll say, and in my personal experience, having rolled up my business a few years ago, it took the time that it took, and there wasn't a fire under us. We had to make sure information was thoroughly exchanged, okay, and trust was built. So you need a good bare bones of the deal as the foundation, and then you have back and forth of information, and you build the deal. And that understanding brings confidence to get to the next step. Now, I will tell you that when I met the purchaser of my business, my practice, I was impressed by his taking the time of day. A phone call became an in-person meeting, became lunch, and it developed. And then he introduced me to people throughout the office, and there were subsequent meetings, and I got a real feel. After all, they were in my field, but I had only seen them at different functions, industry functions. But here, I was able to see how the operations were run, and who was in charge, and the interactions between them. And then I decided to become employed by them. Well, that won't always be the case. There can be ways where your employees will be adequately taken care of, properly communicated with, and as is the way of the world, merger activity will ensue, and they'll be okay. I'm reminded that John F. Kennedy in his inaugural address said, "Sincerity is always subject to proof," which I like. I think that's part of the truth, verify, that Jackie referred to. So what happens also, sometimes you get a positive externality. You learn about this buyer, if you're the seller, and you might end up working with them, even if a deal does not consummate, because you've taken the time to get to know, could be a friendly competitor, could be an upstream distributor, could be someone else in the industry. So it's not time wasted, but just make sure that you proceed to each step, one at a time. So this was not intended to be a checklist for closing or a checklist of due diligence, but more on the formation of the relationship. Okay, thank you very much, and we welcome questions.
Let me address a question to Andrea. What circumstances or signals might precipitate a seller to opt to do an extensive search or even a deep search on a prospective buyer?
Thank you, Andy. This would sort of depend on the end result of the transaction and how it was structured. If the seller will still own a portion of the business, there would be a need to know who the buyer is, since you would be working together and you want to make sure that your continuing investment is safe and there's an upside. If the buyer is also giving the seller debt as part of the consideration, you would want to understand the buyer's financial position and the ability to pay off the debt. Also, if there is a payout or earn-out over time, you would want to understand the financial position of the buyer. If in some instances you sold your company for 100% cash consideration and you asked as part of the transaction, the negotiation for standard reps and warranties and indemnities, and the buyer was unwilling to give them, that might raise a level of suspicion and make you do a deeper dive into their background and why the reluctance to do something that's customary in most transactions.
Thanks, Andrea. Let's see. Next question. In my list here. Jackie, one for you. As we're on a virtual meeting, has the virtualization of meetings taken away substantially from the need of buyer and seller to meet in person? How germane is that still today?
I mean, my favorite line, right, is it is what it is right now. It's kind of my COVID line. You have to get comfortable with it to a certain extent. I mean, as I was searching and for businesses, having conversations with sellers, there wasn't always an option to get on a plane or drive to the location and sit down and have a conversation in person. You have to get creative on Zoom or Skype or a phone call. Is it the same as in person? Absolutely not. Can you get a lot out of somebody? Body language, just getting along in general. You can, and I think you have to adapt to the environment. You need to set up those calls, set up the Zoom. I'm not always condoning drinking, but if it's late at night, if it's a later drink, pour a glass of wine, because it's stressful for everybody, right? Especially, when you're meeting each other and you're having these conversations and, it's a little bit like dating, right? Where it's like, take the pressure off. This is not meant to be high stress, especially at that stage, right? If the first, second, third relations are just so high stress that you're uncomfortable, take a step back and think about it, right? So, relax, spend 20 minutes, 30 minutes talking about life, get to know each other, and this could be done on Zoom, right? And it kind of loosens things up a little bit to get into the financial side. And this is, again, my recommendation on things. Everybody has their own way of doing things. Some people like to get right down to business, and I appreciate that. But for me, who would be stepping in to operate the business, understanding that personal side is very important. There are opportunities now to get out and visit people in person as long as they're comfortable with it. I've flown a few times now. It's very safe. I had an in-person meeting as early as, I believe it was late May. And I went to the office. There was a lot of hand sanitizer. We sat on separate sides of the table. It's doable and it's possible, right? So if you can get out and meet each other in person, and if you're comfortable doing that, whether it's outside at a park and socially distancing, or if it's in an office or wherever you're comfortable, I highly recommend. I think that's by far the preferred method. But Zoom hasn't been terrible. I think it's the expectation that it is a global pandemic and this is a way of communication. If you would have asked me this question in January and February, well, is a virtual meeting enough? My answer right off the bat would have been no. So I'm kind of curious to see how things change going forward, even in end of 2021 going into 2022, when, knock on wood, we're back to we're not wearing these masks anymore, and we're able to meet in person without worrying about catching COVID. Is this going to be is this going to be normal to just have these Zoom meetings? But number one, face to face, really nothing beats it. So.
Thanks, Jackie. Actually, while you were speaking, another question directed at you came in. Jackie, please address unrealistic price expectations by sellers. If a business isn't growing much, the price is not what they think it should be. How do you handle that in your business?
Yeah, right. The topic I feel so multiples have changed during this time. There are a lot of businesses, right? If you kind of look at the spectrum, there are some that, haven't necessarily fared the pandemic as well as others. Revenues dropped, seller discretionary earnings or EBITDA dropped, and it's not necessarily just because of the environment. It's actually, it's inefficiencies within the business, right? So as a buyer, I look at that, right? Is it all industry or is it actually inefficiencies within the business, right? Inefficiencies within the business we could deal with, right? We could come in, there are things that could be changed. Industry-wise, I mean, it could be tougher, right? So if that all drops, seller's expectation of kind of getting paid on multiples pre-pandemic, just because, that's what they were and that's what your business can do. It's not the case anymore, right? You have to value a business on, what they are today and what they are going forward. I mean, if they're, doing extremely well, looking at historical and looking at projected is one thing, but, for businesses that were, materially impacted by COVID, you really have to look at what does this look like going forward? And that means, are these industries going to bounce back? What's going to happen with all of this? So, it's a long way of saying that, everybody needs to come to the table and have a conversation about what's a realistic price for a company. And it's not going to be simply looking at, well, this is what it was because this is what we can do and we know we can get back up there. And if that's the case, then, a lot of times and from a lot of firms that I've spoken to, it's okay, then if you're, then get back up there and then we'll have this conversation, right? So you need to come to the table with a realistic expectation of, okay, we were hurt from the pandemic. The industry is not as strong as it was. We need to kind of readjust. Or if you're booming and things are going crazy and going well, then you can have not only the conversation about, well, pre-pandemic we were doing this, but now we're doing this. So, looking at a little bit of a premium. And as a buyer, I don't like saying that, but it's the truth, right? If you're doing well, your business potentially countercyclically, you could just continue to grow at all stages of an economic life cycle. So yeah, I think there's a lot to take into consideration when you're talking multiples, especially right now, but you can't just look at historicals. Honestly, even looking at trailing 12 months is difficult right now. You have to kind of get creative and think of, ways to really value the business based on the industry and based on the company itself. So I know it's a cop-out answer, but there's a lot of moving pieces right now, and I think everybody's really just trying to figure out, how to potentially standardize it.
Jackie, would you add to that, if I can interject, would you add to that a higher percentage of deals are earnouts because of that?
100%. And I think, and I'm sure you could touch on this as well. I think there will be very few deals right now moving forward for, I would say, even through Q2 of 2021 that won't have an earnout. And the explanation of an earnout is a certain portion of the purchase price that will be based on performance. So as the business performs, you get paid that additional monies, and if it doesn't, then you don't, and the enterprise value of the business will be based on virtually the growth. So yeah, I mean, any deal that I've been looking at, that's part of it, because sellers understand the industry. There'll always be a learning curve for anybody coming in, unless that's your absolute industry. But if they're confident that things are going to go forward, and you need to bridge this gap between what you think the business can do and the industry can do and what they think. An earnout is a great way to come together and say, okay, if it grows at this rate, then that's fine, because the business will be worth this much and you'll earn that extra money. But if the business is flat, then you won't earn that money because the business value hasn't grown. So I think earnouts are, I think that's going to be, as a very standard clause in all contracts and deals going forward.
I would just also add similarly that when I get involved and there's a negotiation of the agreement, there's now a lot more attention paid to material adverse change for measuring what happens, like, for example, between signing and closing. So it's similar to that. There's just a lot of uncertainty, and people are trying to account for that. Thanks, Jackie. Question for Larry. How could divergent employee benefits programs between the seller and the buyer's organizations adversely affect a deal?
Okay, that's a good one. I think I alluded earlier to the buyer being in one region of the country and the seller being in another, and they're looking to expand, but they have an underlying program of benefits which doesn't match up on their network of, say, doctors or dentists or other healthcare providers. But that can be worked through, but you have to attend to it. It can also be the case with this acquisition, the total number of full-time employees as calculated under the Affordable Care Act and other laws, full-time equivalent employees they're called now, exceeds a certain number. And now a different set of rules apply with mandates on the employer to cover minimum coverage that they never had before. So a buyer should be well advised from their end to see where the aggregation tips a scale. And it's not just with the legal regulations and these fines, which are assessed automatically by computer, shifting the burden to the employer to demonstrate compliance, but it's also where the marketplace responds. You can have a tiny company in one part of the country acquire a larger entity, a greater number of employees, I'll say. And now they need to have coverage. They need to have a plan designed around that. So the demographic change in the composite between the buyer and the seller employees, right? That's a relevant aspect. And one other thing I just point out, if you have a qualified retirement plan and the acquirer has a generous matching program for perhaps safe harbor or other purpose, and they attract and retain good people in that fashion, they contribute X% of pay, whereas the seller being acquired does not. So that could be a windfall for the seller employees. But what if it's the opposite way? What if the seller's employees are used to having, they put in X and they get 2X right away? That can be the case on these matching programs. You just have to take it that extra step. Now, I don't think you get there day one. I'll just call you back to my prior conversation that this will evolve over time, but it gets there before you ask about your benefits, like in a job interview. It should get there partway through, halfway through. I want to comment on one other thing that Jackie was talking about the virtualization. We all know that when you can meet each other in person, that much more information gets exchanged than legalities, than documents, than financial documentation. There's intangible things that happen. Gestural language, trust can follow or not. And sometimes that's very important as well. Now, we know many big deals have happened without virtualization, without communications through Zoom and WebEx. But if given the choice, I recommend it. So, thanks.
Thanks for that. Let's see. Another question for Andrea. Okay. How important is a transferable, replicable process and management to the buyer once the principal and founder may no longer be affiliated post-sale in the transition?
Well, even if the seller isn't going to be part of the transition process, you would still want to make sure that there's a good infrastructure in place and processes in places. Because are there systems in place that could be transferred to assure continuity of the business? And also, one would want to preserve certain business relationships and customer relationships that have existed in prior to the transition period, and you want to keep those relationships and also customer knowledge and institutional knowledge in place so that the post-transition can be a smooth process.
Thanks, Andrea. Jackie, I have another question for you. I think you might have addressed it on the price expectations question that came in, but I'll just go ahead with it. During COVID-19, haven't many of the multiple historical bases for valuation gone away? Is more of the deal based upon factors other than pre-pandemic rates, et cetera?
Yeah. I think it's and it is important to bring it up because I think as an industry as a whole, everybody's just trying to figure out, how to value businesses when, historical performance, it might not come into play as much as it used to. And right, everybody's used to looking at 2012, how did you do in the last few months or the last few years? Let's see how you did during the financial crisis and to see how resilient the business is. I mean, as a buyer, I think it's an interesting time, right? I don't have to look for 2008 and 2009 numbers. We're living it, right? And we're feeling it, kind of this global, social, financial, heat of this. So, when you're in it, you just have to look at all of these different pieces. And I don't think the historical part will play as big of a make as big of an impact as it used to, but it will definitely be more of how are you doing right now and what does the future look like? And also part of that, what's changing in how your business operates in the entire industry that could potentially help it or hurt it. So you have all of these moving pieces. And one other piece that I will bring up, and it's looking at the customer base. So when you look at businesses and say, okay, what is this recurring? Is it recurring revenue? Are there sticky customers? Who are they servicing? These industries, those industries are growing, which help growth of this company. You really, really have to look at who customers are now. You could be an absolute, necessary. Like you could talk HIPAA compliant software that businesses need. But if your customers are feeling the pinch and they don't survive, it doesn't matter how necessary or how many tailwinds you have behind your business and your industry. So I think now, too, it's taking another step into looking at who the customer is and not just, oh, look, they've been customers for a while, but how is this affecting them? Can they sustain? Are there a lot of acquisitions in the market? Is it fragmented? Are there these big players that come in and just, soak up everything and take away that service from you? So, on top of historical, I think really looking at the customer base is going to be huge.
I think I have one more question for Larry, and while he's speaking, if anyone has any last-minute questions from our participants, please send them in on the Q&A button. But I'll ask Larry a question here. When might a retirement or medical plan be adversely affected by a merger, acquisition, or another type of transaction, and might it be a deal?
Okay. Thinking about that, you'd have something what I was referring to earlier with the count, the number of eligible employees, which upon acquisition will grow. And depending on what test you're putting that to, medical insurance, qualified retirement plans, that could trigger audits. For instance, over 100 people, all your qualified plans are audited annually. It could affect also the penalties, as I alluded to earlier. So there are other regulatory aspects that are affected by that. So, the fact that HIPAA and the Affordable Care Act have been given teeth and given digital enforcement, shifting the onus to the employer, as I referred to, you've got situations where if non-compliance occurs, There could be penalties assessed, for instance, by the Department of Labor each day for the total number of employees. That could put a company out of business. And yes, they'll go retroactively. So sometimes the date of a closing is important because these calculations can be done. A monthly tabulation of employees and then an averaging over 12 months. And then they see the date you closed and they see if that number is weighted greater or less than, the figure involved, 50, 100, and other figures apply too. So some of these considerations are important, and they can sink a deal because it becomes unpalatable if those costs get out of hand, being that employee benefit costs are second or third on the list between rent, salaries. Maybe rent's going down these days in the pandemic, right, if they're not renewing as much space, but not these benefits. Now, the other thing is there's no forgiveness these days. You've seen COVID-related medical claims being covered, and now you're going to see an onslaught of recovery on some of those too, because that was not signed in good faith if the claim was not COVID-related. Well, similarly, these regulations come with stiff penalties, which are assessed, not with forgiveness. Thank you.
Okay, thanks, Larry. Unless any of the other panelists have anything further they wanted to add, I think we're reaching the end of our time here, and there aren't any other questions. So I'd like to thank our excellent panelists, Jackie, Andrea, and Larry. Really appreciate you sharing your wisdom with us, and thanks to the participants for joining. Have a good day.
Thanks so much, guys.
Thank you, everyone.